daily premium newsletter for May 23rd, 2018. So the market is certainly angry right now. May until a week ago was looking like a consolidation and a small pullback from the bullish action we saw in April. What began as a small pullback turned into a full-blown storm this week, with nearly all of the large caps showing double-digit losses on the 7-day chart. So what's causing this to happen? Well, simply, people aren't entering crypto right now, and they haven't been since January. Couple this with fears about regulation that we discussed yesterday, and you have the perfect storm. As we often like to say during days like today, nothing has fundamentally changed. While some of the news has been eyebrow-raising of late, it should have no far-reaching implications for the legitimate actors in the space. 2018 is shaping up to be a big year for crypto, but not in the ways we initially suspected. This is the year that defines crypto's role to come, but unfortunately as the market and technology have become more stratified, it becomes harder to perceive that direction. When the market was defined solely by Bitcoin, it was easy to see the direction of the wind, but 2017 changed that in a big way. Suddenly we went from one dominant voice to many different voices. The cacophony is somewhat hard to sift through, and the significance of a diversified market is lost on many outside the space. But make no mistake, the frustrations and stagnation that you feel today will be worth the toil. Defining a new asset class that lives outside the normal conventions is not done overnight, nor do we want it to be. We want regulators to get it right the first time, and regulators want to fight crime without stifling innovation. It's a tough balance to achieve, and the best we can do right now is explore the possibilities of the technology. After all, that's truly the purpose here. Yes, we're speculative investors, and there's a profit motivation. But if you ever get a chance to talk to other crypto investors, the ubiquitous rhetoric is not about price, but about purpose. So the point here is that what we're feeling right now is temporary. When everyone else is jumping ship, you can look for opportunities. We've been bouncing between Bitcoin at $6,000 and $10,000 for nearly 6 months now, and as the range tightens, the probability of breakout is growing. Echoing that, Fundstrat co-founder Tom Lee is predicting that Bitcoin will reach a price of $25,000. And while we normally ignore price predictions, he makes 3 salient points about what will come to pass. First, he points to Bitcoin production and replication costs. As it stands, the price of production, or mining, is almost equal to the trading price. In order to incentivize more miners, price needs to go up to make mining viable. Second, institutional investors haven't fully entered the industry due to regulatory uncertainties. Third, data compiled by Fundstrat shows a historical trend, indicating an uptrend is likely. Again, anyone can make predictions, but Lee's logic follows a lot of what we've been saying. We won't declare that a bull run is imminent, but it's clear to us that price is being suppressed. Another event sending shockwaves throughout the market today has been a series of network hacks for large cryptocurrencies. Both Bitcoin Gold as well as Verge, who are both in the top 35 by market cap, suffered 51% attacks that allowed the perpetrators to steal millions of these cryptos. To execute the attack, the nefarious actor had at least 51% of the network's total hash power, giving them temporary control of the respective blockchains. To control that much hash power is very expensive in terms of the hardware and electricity needed, but the cost can be offset by the attack. All told, the attackers made off with an estimated 18.6 million in Bitcoin Gold and mined an estimated 1.75 million in Verge. This highlights some of the issues inherent with proof-of-work consensus, otherwise known as mining, and why much of the crypto community has been shifting away from it towards algorithms such as proof-of-stake and delegated proof-of-stake. Last for today, Coinbase announced that it took another step towards trading Ethereum ERC-20 tokens by acquiring exchange Paradex. Paradex is a decentralized exchange, or DEX, meaning no third party is involved in holding the funds. This is in comparison to a centralized exchange like Coinbase or Binance, although both clearly have intentions to have decentralized options. Paradex is built on top of the 0x protocol, which had a very impressive day as it was seen as confirmation that 0x will trade on Coinbase soon. So what is the implication here other than Coinbase is continuing to grow more powerful? Well, because US regulators are trying to figure out how to define legislation for cryptocurrencies, many exchanges have been holding back from listing ICO tokens. In March of this year, the US Securities and Exchange Commission, or SEC, issued a clear warning to crypto exchanges that some ICO tokens may qualify as non-compliant securities as they fail the Howey test. And any exchange that lists security tokens needs to either register as a national securities exchange or use an exemption by setting itself up as an alternative trading system, or ATS. So what we learned earlier this week is that Coinbase reportedly entered into talks with the SEC in April in order to become an ATS. Coinbase had already announced in March that it was adding support for ERC-20 tokens, and now we can start to finally connect the dots as to where it's going. Coinbase CEO Brian Armstrong stated in today's announcement that Coinbase will only offer Paradex to customers outside the US, and move to US customers as regulatory uncertainties become more clear. So for his thoughts on the market, I'll turn it over to Doc. Have a great rest of your day. We'll talk to you tomorrow.
Good evening. It's Doc for ReadySetCrypto for Wednesday the 23rd. Look, there's no sugarcoating it here. We are still in a bear market. We're still in a primary downtrend, and this is what I was a little concerned about. A couple of weeks ago, as we came up to the top here, I said, be careful. Don't get too optimistic here, because we're still in the grips of this bear, and this bear is still showing us lower highs and lower lows on a weekly chart. So rule number one of my price action is larger time frames dominate the trend. And right now the trend has been to the downside since we crossed into 2018. So lower highs, lower lows, lower highs, and we'll see whether or not this prints a lower low, or whether we can hope that this prints a higher low and then we start to squeeze. Now, there's a couple of things that I want you guys to look for here in terms of reversals. So rule number one is that larger time frames dominate the trend. However, the converse of that rule is reversals start from the inside out. Now, what do you mean by that? Okay, so off of the weekly chart, let's go over to something like the 4-hour chart. Let's go to the 4-hour chart. And what I want to do is I want to go way back in time here to the actual reversal that we had back up to an uptrend. So we had that nice little swing in April, right? We had a little swing to the upside for a few weeks in April. That was nice. Everybody enjoyed that. How can we identify the next one of those? How can we trade inside the next one of those? Well, there's a few things that we can identify here. So first of all, what we're going to find is that downtrends like this are going to throw off some trend lines. So we're always looking for trend lines that we can identify, and descending patterns like this, descending patterns always break to the upside. So when we have descending patterns like this breaking to the upside, especially in Mongo volume like this, if we have big volume coming in. So notice how all these were lower highs and lower lows, and all of a sudden, boom, we start printing higher lows and higher highs. And so that's a swing we can play within. Okay, so that's one way we can watch for that. Let's go back over to the daily chart again. And let's go back to this. Now, something else that we can use, again, keep that in mind, that period of time over here back in mid-April where we had that reversal. So something else that we can use to identify those is what's called the Heiken Ashi candles. Heiken Ashi candles, if you're using TradingView, is available over here where you select the candles in the upper left-hand corner and go down to Heiken Ashi. And what we can look for here is that red candles signify a swing to the downside, green candles signify a swing to the upside. So we started to see these candles turning green around the day, around the 11th of April, 11th or 12th of April, it was game on. 11th or 12th of April, it was game on. Now, what I also want to bring to your attention, and this is where we can use the chop index, we also, at that point, I don't know if you guys remember me talking about this, but I said, hey, we got a lot of energy. It's not making a new low here, so we may see this pop to the upside. That's what we did. Big energy peak here on the chop index. But also remember that big energy peaks can go both ways. So we had a big energy peak here. This doesn't tell us which way the price is going to go. This is where we have to look for price action, or we can also use the Heiken Ashi candles to identify, uh-oh, this trend is starting to migrate to the downside. So you can clearly see the red candles here showing up. And on the 4-hour chart, that is, we're not seeing any change right now in that. That's definitely still heading to the downside, right? So all those candles still heading to the downside on the 4-hour chart in a hurry, right? So we're not seeing any reversal there. A lot of volume, though, showing up as we get into kind of a capitulation mode. Eventually, we will start to see capitulation, and that will mark a short-term bottom. The other thing I want to bring to your attention is, we don't spend much time talking about this, but these little news articles down here in the lower right-hand corner, what I want you to watch for is when they all turn universally negative. This will mark, almost with uncanny accuracy, a short-term bottom. When all of a sudden all of the mainstream news, whether or not it's for the regular stock market or whether it's for the crypto market, all of a sudden becomes universally negative, then typically this is where we will see a bottom show up very soon after that. It's always darkest right before the dawn. So again, guys, let me close by telling you that technical analysis is not to be meant as some sort of crystal ball or sort of future prediction machine. This is not what it's for. It's for giving yourself a decision framework. And so everything I've talked to you about tonight is giving you a decision framework. Use the Heikin-Ashi candles, use smaller time frames, use those fractals, use those energies. Understand what the chart is telling you and understand how to apply that towards a probability that we're starting to see things move. Watch for those descending trend lines to get broken to the upside. Pile on the evidence. Look for the capitulation. Look for the articles. Look for all the negativity, right? It will always pay to be on the other side of the investing herd when everybody is most negative, when everybody is capitulating and saying, I quit, I can't take this anymore. That is where the relief rally will show up from, and nobody will be on it except for perhaps you and I. And that's it for today's report. Thanks for listening, folks. We'll see you tomorrow.